Welcome everybody to episode 5 of the Harry Sale Wealth Show. Today I have Karl Pawlina in front of me. He'll explain a little bit more about what he does, but really the conversation today is geared towards how can professionals incorporate, some of the benefits there, and really just having a nice conversation. So Karl, welcome to the show.
Thank you so much for having me, Harry. My name is Karl Pawlina. I'm a lawyer licensed to practice in Ontario. Anytime a lawyer comes on a podcast, you will usually make the same disclaimer, so I'm going to make it now. This podcast shouldn't be relied on as legal advice and is not legal advice. I am a lawyer, but I am not your lawyer.
Tell us about Pawlina Law and your specialization and just an overview.
Yeah, so I graduated from Osgoode Hall in 2015, was called to the bar in 2016, so I'm now going on 9 years. And right after finishing being called to the bar, I started my own firm. So it's been a while. I help almost all my clients are individuals that incorporate and generally grew their business. I have a couple of clients that are small and medium enterprises, but generally within the small business space is where I operate.
So the people you primarily work with, incorporated professionals or?
Yeah, so I just opened a matter before this call. So it's my 444th matter that I think about half of them have been corporations and about 1/3 of those incorporations were professional corporations.
Yeah, so that gives a bit of a background about yourself, what you do, really even just winding the clocks a bit back further. How did you even get into the business?
I was studying engineering. I still proudly wear my iron ring. And I went to a pub night one night with a friend, and he was in the arts, and he said, I'm applying to law school. And I said, oh, how difficult is that? It's like, you just have to write the LSAT and have a decent GPA and you can apply. So, okay. So I wrote the LSAT, and it was interested me. It was 2012. Canadian economy wasn't looking great. The outlook for engineers in 2012 with the decline in oil prices and research in motion or BlackBerry going downhill really had limited jobs for at least engineering, the sphere I was in. So I wanted to see what was next. Law interested me. So I ended up pursuing it. And then after I finished in 2015, Canadian economy still wasn't doing that great. Oil was down, limited opportunities for lawyers. So my dad, immigrant from Poland, encouraged me to open up my own firm. He came here with nothing and started contracting here or there just to get by. And he said if he did fine with no English, no Canadian education, I'll do fine with English and being educated. And he was right.
A number of people I work with specifically are incorporated professionals or professionals looking to incorporate. One of the number one questions I get is, when should I consider incorporating? So maybe just give us a bit of information on that.
So everyone will be different. It all depends on how much money you make, how much money you need, and in certain scenarios, can you even incorporate? Are you just an employee and you have no option to incorporate? So first is figure out if you're an employee. This is particularly important for doctors. Some are staff. Some hospitals allow specific staff physicians to incorporate, others not to. I see this issue in the GTA a lot. So figure out if you're permitted to incorporate by your regulatory college and your employer or who you contract for, and then speak to your accountant and tax advisor to see if it makes sense for you. Because if you're making $80,000 a year as a resident, it almost never pays to incorporate unless there's a tax planning reason behind it. But if you're making, upwards of 150,000, that's when you should start having that conversation with your tax planning professional. There's a gentleman named Jamie Gowenbeck from CIBC that does a wonderful job in providing case scenarios as to when someone should incorporate. Reviewing those scenarios will give you some advice, but ultimately speaking with your tax professional that sees your tax filings, sees where your life is, that will determine whether or not you should incorporate.
Some of the people that might say, okay, Harry, I might be ready to incorporate, but I don't really know what the risks are if I don't, or perhaps if I incorporate incorrectly. Can you give us maybe a bit of insight on the downsides of incorporating, or maybe if there's a risk of actually incorporating?
Yeah, so the downside would be throwaway costs. You incorporate and you find out that your hospital actually doesn't let you operate as a professional corporation. Well, then you have to wind up your corporation. You'll have tax filings, legal fees, filing fees associated with that. A great question you asked is what are the risks of incorrectly incorporating? Well, you'll have to fix it. The amount of times I've seen people incorporate incorrectly because they use the online corporation service, significant. So people will just incorporate a federal corporation for a professional corporation, not permitted. Professional corporations in Ontario need to be Ontario corporations. So, or their names are incorrect. Rather than saying medicine professional corporation, they'll say medical professional corporation, which is incorrect, or they'll use terms that they're not allowed to use in their professional corporation, which is non-compliant with the Ontario Business Corporations Act, and a lot of bylaws or governing statutes of regulatory bodies. So that's the risk, incorporating incorrectly. Just additional legal costs, delay, expenses, and just general headache.
We've heard a number of people say, I'm considering incorporating. There's a number of costs, the ongoing filings, the maintenance of records and things like that to keep track of. So there's definitely risks from what we've seen. Some people who are, starting a business might want to know the difference really between, breaking it all the way back to what's the difference between a sole proprietor and an incorporated person. So maybe just walk us through the differences of both from a legal perspective and what you've seen in terms of sole proprietors versus incorporated professionals.
Yeah. So first I'll talk about sole proprietor versus an incorporated business, and then I'll talk about incorporated business versus a professional corporation. So a corporation has a complete separate legal existence. Its liabilities are the corporation's liabilities and not your personal liabilities. So if the corporation gets sued, only the assets of the corporation are liable to fulfill any judgment, subject to certain limited exceptions, typically fraud. So that's the difference between a sole proprietor and professional corporation. And also from a tax perspective, a corporation can retain earnings, and you on a personal level, the owner, will only pay taxes on what's being pulled out of the corporation. Now, if you're a sole proprietor, all the income you get in is your personal income. All of the liabilities from your operation are your personal liabilities. So the separate legal existence is very important. Now, the difference between a professional corporation and a corporation from a tax perspective is near identical. But from the liability perspective, a professional corporation does not get the benefit of limited liability for professional negligence. So a big value of a corporation is that limited liability. That doesn't exist in for a professional. The way a professional gets to protect themselves is through insurance policies. So that's a huge drawback of the professional corporation because you don't get that benefit. That being said, the tax benefits still exist. And the tax benefits we'll discuss them a little bit here, but there's lots of information online about the tax benefits.
One of the things that I'm really doing in my business is focusing on incorporated professionals, as I mentioned. And what they say to me is, okay, I'm ready to take the steps. I understand the risks. I understand, I'm at the right level. How do I get this done? So really maybe just walk us through the legal steps or the key steps in setting up a professional corporation and who needs to be involved at each step.
So the lawyer and the accountant are typically the two people you want involved from day one. So it takes me 2 business days to set up a professional corporation. If I'm really pressed, I can set up the professional corporation in a couple hours and then deliver. The reason it takes 2 business days is because overnight, the Ontario Business Registry, which is the system used to incorporate your company, and the CRA exchange information. So the CRA will automatically update your business number for CRA accounts overnight. So I usually incorporate on day 1, and then on day 2, I'll get the business number and report the whole matter to the client. So that's the legal part. Before I incorporate, I like to speak with the professional's accountant to make sure that I'm meeting all their tax planning objectives. And what could these tax objectives be? So certain professions, not all of them, pretty much dentists and doctors, allow for a little bit more flexibility as to who can own shares. So family members can own shares. There's been recent changes in legislation that have limited the ability to income sprinkle or tax split amongst family members. So obviously, the accountant will have to be cognizant of that. But there's still some opportunities depending on the circumstances of the professional. So I like to touch base with the accountant to make sure if they need anything, it's included in the incorporation. And then once I have that direction, I can get everything done in 2 business days.
It's good to have your accountant, good to have your lawyer, and of course, your financial advisor at some point. And really just to touch on what you just mentioned, there are certain professions that can have spouses or other shareholders and certain professions that can't. Maybe just for a lot of people here who might be vets or physios or chiros or anything else, maybe just if off the top of your head, if there's a list of people who can have other shareholders and people who can't, just to list them if you can.
So any regulated health profession, generally, so chiropractors, psychotherapists, psychologists, physiotherapists, massage therapists, you cannot have a spouse be a shareholder except doctors and dentists. Now let's go outside the health professions. Lawyers, CPAs, accountants cannot explain. I cannot refer, or I do not know right now veterinarians if they can or cannot, but I would have to check on that one. And then the last one would be social workers. I would have to check on that one as well. But my gut says, no, you cannot.
Yeah, it's interesting. I've had a number of people come up to me and say, I'm really happy that I can expand on the lifetime capital gains exemption and maybe spread it across some different shareholders and what have you. So some of the advice we do give is that you need to make sure that you're checking with your accountant on that and who can actually be part of that shareholder agreement so that you can split it up and maybe have, multiplications of that, lifetime capital gains exemption. So it's really good advice to know prior to doing these things. Maybe they can talk to you, they can talk to their accountant and say, hey, am I eligible to actually have somebody on my corporation, and who can actually benefit as well through my family.
Yeah, yeah. So for those type of transactions, multiplying lifetime capital gains exemptions, most lawyers, if not almost all lawyers, rely or request a step memo from an accountant to advise on the tax aspects, and then the lawyer would implement those tax planning aspects.
We've seen who can incorporate and exactly, what the process kind of looks like. What might be the next steps for a person who is newly incorporated to consider for their first year? Maybe some mistakes that you've seen certain people make in setting things up, or, what can they do to really take advantage of that corporation, from day one, after they open it?
A couple of mistakes I've seen is right after incorporation, a professional needs to apply for their certificate of authorization from their college. So they'll have to submit documents, and then the college will return to them the certificate of authorization, which allows the profession to operate in the regulated profession. And the second thing is they'll need new tax accounts. They'll need, if they're subject to HST, they'll need new HST numbers. If they'll need to open up a new bank account, because this is a new person. So you can't operate in your own bank. You can't operate under your own old bank account. You'll have to update all your vendors, your suppliers, your customers, your agreements. It's a new person that's coming into existence. It's a corporation, so it doesn't physically exist in a space, but all these documents will need to be updated.
Yeah. Yeah, so there's a number of things to keep in mind here. Now, in your experience, have you had the person take care of most of that? Have you had the accountant, be involved? Are you involved? Maybe just a bit more about how they can organize everything and who would be the right person to do it.
So there's been confusion over the years as to who's required to do certain steps. So now my engagement agreement is very clear that I do not open up bank accounts for clients. I do not open up tax accounts for clients. I will provide them with their business number, and they can select the accounts they need to open. And why do I do this? Well, some professions are HST exempt, like psychologists. So their services are HST exempt. That doesn't mean all of their services are HST exempt. There are services that are subject to HST. Now, I don't know if they're offering those services. They will need to know what's subject to HST, what's not subject to HST. So I lead them to open up their tax accounts. If they employ people, it's up to them to open up the appropriate payroll accounts with the CRA.
That's it. If you are, at that point, speak to your professional and try to get as much help as you can. If you have questions like that, speaking to someone like Karl, your accountant, or myself, we can always coordinate. I've heard a lot of physios might say, I want to either expand my practice or partner with a clinic, things like that. Maybe not specific to physios or anybody specifically, but what might be important to consider when an incorporated professional is expanding or trying to partner maybe in a medical clinic?
So that's a great question. Whatever you do, make sure it's written down on paper. I have an article on my website called Handshake Hell, and it happens too often where people will partner with no agreement in place, and then there's a dispute, whether it's 6 months or 6 years down the line. The difference between having agreement on day one and having no agreement in place can be tens of thousands of dollars. So whatever you do, make sure it's properly documented. And secondly, recognize if you're operating between colleges, you need proper legal advice. So we drive by clinics all the time. They'll say physio, massage therapy, and chiropractic services. That is a landmine of potential issues because you have to comply with each college's regulations, and each college's regulations are different. So there's no one size fits all approach. You have to, even at times speak with every individual college to make sure the structure you have in place complies with each college's rules.
I'm sure that's hard to reconcile. You've already been so busy opening up your professional corp. You've already been focused on your business, and then partnering with the clinic can be sticky. So again, that's another inflection point where you might want to say, let's talk to your team.
Yeah. And a lot of the time, I will say, does this even make financial sense for you? Is it worth pouring all these resources in for no guaranteed minimums from this clinic.
And you talked about it, you touched on it just briefly earlier about shareholder agreements. So I think that's a really key factor. Not a lot of people might think about it. At some point in their career, they really need to know, am I going to be partnering? What's my agreement going to look like? So what are some key facts about shareholder agreements that professionals should know? And then maybe even with a lens towards exit planning. So for example, having an agreement, getting things ready for their exit, what do they need to know now and what do they need to know towards the end of their career?
Yeah. So shareholder agreements for professional corporations are limited. There are very limited exceptions, but generally to professionals within the profession. So if you cannot sort of use a shareholder agreement to pull out control from a professional corporation, from the regulated individual, shareholder agreements are made on should be made on day one and then put into a drawer and only used when needed. And pretty much all corporations come to an end. And now we're seeing the possible end of one of the oldest corporations, Hudson's Bay Corporation. So when you have a shareholder agreement in place, it will deal with the difficult scenarios, death, disability, dispute. And the difference between having that shareholder agreement pulled out in those scenarios and not pulled out is tens of thousands of dollars, especially if there's a dispute. When people want to fight on a dispute on a shareholder agreement, without a shareholder agreement, it goes in court and it can go forever. Maybe not forever, but it can go for years and tens of thousands of dollars later. Versus I charge $1,500 for pretty much a set form of shareholder agreement. If both people are coming in on the same terms and they can pretty much want a fair playing field, if they get into a dispute, death, disability, $1,500 at the onset could save $15,000 in a dispute down the road.
Yeah. It actually sounds very parallel to having a will in place in terms of your financial assets.
Absolutely. I don't practice wills, but in the strongest possible terms, I recommend everyone get a will for themselves as quickly as possible. And if you own shares in a professional corporation, you should be considering having a primary and a secondary will because there's tax planning opportunities in that.
Go. Glad you brought that up. That's certainly something that we do as financial advisors, and we can put that together in terms of, the structure, but you always need to speak to your lawyer in terms of getting that will actually settled. So that's fantastic advice. Really, before we switch gears, there's some people who might be looking towards an exit within the next 5 years. What advice could you give them?
So I would say if you're looking at exit in the next 5 years, speak with a business broker sooner rather than later. So business brokers are well positioned to prepare your business for sale. Lawyers will transact the agreements for you, but we don't prep the business for sale. I mean, some lawyers might, but I don't. And when we prep the business for sale is, advise that you have audited financial statements. Advise that if you have any sort of retained earnings, you start working on a plan to pull them out. Advise that, you clean up your books to make sure if there's any sort of personal use items that they're out of the corporation, because you're not going to be selling personal use items to a potential purchaser, and they don't want to buy personal use items from you.
And really, as we kind of wrap up and go towards more of the rapid fire questions, one question I always want to ask people who I have on this show is, what's one piece of advice you wish you could tell every professional you knew before they were incorporated?
Speak with your accountant, particularly if you need a Section 85 rollover. So Section 85 rollover, Section 85 is in the Income Tax Act, and it's a mechanism by which the CRA allows an individual to roll over assets that they hold personally as a sole proprietorship to a corporation. So that rollover is dictated by an accountant. And why is it dictated by an accountant? Because the accountant knows what you've been writing off, what assets you hold, and if you need a Section 85 rollover. So if you have someone that's finished law school or day one, they have no assets, they have no business, they haven't done anything, and they incorporate their business on day one because they believe they're going to grow large in their first year without even the financial reasons to incorporate. You probably won't need a Section 85 rollover. But you've been operating for years, there's goodwill associated with your name, a client list, recurring revenue, then you might want to consider a Section 85 rollover. So my advice is never incorporate before getting proper legal and tax advice.
Yeah. No, that's what we'd always say is, make sure that you have the advisory team because you need to take this seriously. This is your livelihood. This is your business. Make sure that you're consulting with the proper people, and people like yourself, myself, and the accounting team that we work with are here to provide that professional advice. And it's really something that's incredibly important. So Glad you brought that up. Before we move into some of the scenario questions, what's the first step for somebody who's ready to incorporate? What can they do if they're watching this video right now and say, I'm ready? What's the first thing that they should do?
They should flip an email to a lawyer of their choosing. Always happy to help, but a lawyer of their choosing and say, hey, can we jump on a courtesy call to figure out what our next steps are, who we need to coordinate to get this done? I offer free unlimited calls to all my incorporation clients. If they have questions about their incorporation, they can call me and there won't be additional costs.
I wanted to really shift into is some of the questions that I've received from some people. I know we might have touched on this, but some of the people that come up to me and they say, Harry, I'm a little bit nervous. I don't want to make a mistake. What do you see as the biggest mistake you see medical professionals making when it comes to incorporation?
I mean, when it comes to medical incorporation, the biggest mistake is doing it themselves and having it done wrong. In terms of bigger financial mistakes that they make, and I see this too much, these side projects for medical professionals. Almost every professional is too busy. So when they start a passion project, they'll do it half-heartedly and it'll end up being a huge financial drain on them. So I advise strongly against financial side projects. I advise if you have a locum opportunity, just take locums if you need more money. And obviously the second thing is living firmly within your means. I think it's been well documented, lifestyle creep amongst physicians, especially when you go from residency to attending. So just to make sure you live within your means to prevent, having to be overworked and overtaxed.
Living within your means, that's one of the biggest things as financial planners we also advocate for. So that's fantastic. I work with a number of professionals. They're in different aspects of the medical field. So I had one question come through, which is, as a family physician, I've heard conflicting advice about share structures in medical professional corporations. What's a common mistake you might see doctors making if they're setting up a corporation share structure?
Yeah, so a common mistake is just having one class of common shares. That might work in some scenarios, but in almost every physician, for almost every physician I incorporate, there's a specific share structure I use. And that share structure is used to allow for a Section 85 rollover. That share structure is used to allow voting common shares to be owned by licensed professionals and to allow non-voting common shares to be owned by family members. I said earlier that there is limited tax planning opportunities for family members, but there still is some, depending on the lifestyle and circumstances of the individual.
The next question was from a newly licensed dentist. So I work with a number of dentists who have just started their practice. They are thinking about incorporating. We've touched on this a little bit earlier, but one of the questions that came through from them is it too early for me to think about incorporating if they're just newly licensed?
So for dentists and all non-resident doctors, the income is almost, in the vast majority of scenarios, the income warrants incorporation on day one. So as a dentist, it's very common for dentists to incorporate on day one because they know how much money they're going to be making in their first year. And same for most physicians.
There's a physiotherapy practitioner that I'm working with. So what he said is, I've just incorporated my physiotherapy practice. What's the first legal step I should take now to ensure my corporation is properly set up and compliant?
So the first step after incorporation is getting your certificate of authorization. And then after that, you'll have to do annual meetings. So within 6 months of the end of your first fiscal year and every fiscal year thereafter, you'll need to complete annual meeting minutes. So there's tons of precedents online. The vast majority of professionals do never complete this step, but it's required to be compliant with the Ontario Business Corporations Act.
And just as a follow-up to that, if you're not keeping minutes, if you've commonly seen that, what might be the repercussion?
So great question. I've yet to see a case of repercussions happening, but I've seen an argument before that not for professional corporation, lack of record keeping sort of shows that a corporation isn't actually operating. Now, this argument can be debated significantly, but the repercussions are unknown at this point. But if all one has to do is complete their annual resolutions, which could take an hour or less per year, then it's strongly advised to do so.
Fantastic. There's just one question I wanted to end on. It's the physio that is partnered with somebody who owns multiple clinics. That person who owns the multiple clinics is really saying, similar question to what we talked about earlier, that they want to be exiting at some point, maybe within the next 5 years. What advice would you give them to really prepare for that exit?
Very clean books, very clean corporate records. There's a huge difference when you ask. So when you're acquiring a clinic and you say, can you send me your minute book? And if you send just the articles of incorporation, which has happened before, here's my minute book. And I said, well, there's nothing here other than your articles of incorporation, which I could have just pulled for the business registry. So you have no corporate minute book. And if you have no corporate minute book, how am I supposed to know what your stated capital is? What's your issued capital? Who owns what? So that's why, if you want to sell your practice, have clean accounting records, possibly even audited financial statements to sort of show that everything is as it shows, and have clean corporate records. When you send the minute book to the counsel for the purchaser, the counsel just says, wow, this is great. All right, we know who owns it. Everything's clean. We can pursue the transaction rather than having to fix everything, which adds time and expense.
Take care of it now so you don't have to take care of it later.
Yep.
Great. Well, we've kind of reached the end, Karl. I know we've talked a little bit about what you do and who you work with. I hope that there's a lot of value so listeners can really, understand what you do and the value you provide. But I just want to say thank you very much for joining us today.
All right. Thank you so much for having me.